may think, well, what does that have anything to do with it? Well, it doesn't have to do anything with that because the insurance company's not guaranteeing the HVAC system, but if they're calculating what's its likelihood of failing, particularly in the middle of winter, when it fails long enough, you're going to have frozen pipes, which is going to cause a loss. So they're concerned about the age of that. Then the loss history of the property. How many claims have been against that property in the last 3 or 5 years? And so that's usually when we ask the owner if they know. Of course, if somebody's buying a new house, they're not going to know. So we have to run what's called a clue report and get the history of that. Vital information that we have to get to put into that. When we submit all this information to the company and their systems, if it all fits within a guideline, it spits back and gives us premium. Then the insured says, okay, great, I'm going to go with that. We bind the policy with an effective date. And then only after that time, do they actually sign an application. So it's a little bit backwards. We actually issue the policy and bind it, and then they've signed the application. This is all now done electronically. But the important thing is that on the application, it's going to list all the facts we just gathered about the roof age and the HVAC age and all that HVAC system age, etc. And the signature of the insured is going to say that they're testing that information is true. Now, why is that important? Because that becomes part of the policy, part of the record. So if down the road there's a claim, you have a roof leak, and you said the roof was 5 years old, and they come out and they say, that roof wasn't 5 years old. You've just given the insurance company an out to potentially deny a claim. So it's really important that we get the information accurate and put it on there, and that people actually read what they sign, because you basically are doing a contract. And so after the policy is bound in a typical scenario, then the insurance company will typically do an inspection. So usually that's a third party they hire to go out and use just an exterior inspection, unless it's a very expensive home or something. And then they'll require an interior inspection. And they're basically going to look and say, is the house as it was represented in the application? Is it, and also, is there any obvious damage or anything like that? Usually it's pretty cursory, but if the inspections find something wrong with the house that doesn't mess with the application, then they will typically issue a letter saying, hey, this is wrong, you've got to fix it, you got 60 days to fix it or something like that. And if you don't fix it, they will cancel the policy. So again, it doesn't create a good situation for the customer for that to happen. So we've got to spend a lot of time up front making sure that it's accurate. So that's basically the process, how insurance works. So now, what are the 5 things I think you should know? So first of all, we'll go back and focus on the first one, is that the replacement cost. Replacement cost is what the insurance company thinks it's going to take to rebuild the house as it is in the case of a complete loss. Burns to the ground, hurricane wipes it out, whatever. Typically, it's estimated based on the square footage of the house. Now, it's interesting, when you do these estimations, they don't include the square footage of the finished attic or basement. So this is an important thing. A lot of times I'll see listings, an advertised house is 4,500 square feet, but 1,500 of that is the basement. So I've got to make sure that I accurately put in 3,000 square foot into the estimate, or I'm going to overestimate the rebuild cost of the house, which is going to drive up the premium and make the premium larger than it needs to be. So we've always got to be careful in including the proper amount of square footage into the estimation process. Then basically the quality of the bathroom. Some of this is a little bit subjective, but it's based on the guidelines that the individual insurance company uses in their estimation. We put all that information in there. Where'd I go? Okay, hit the button there. Now here's another thing, is that the type of construction materials. The most common around here is frame construction, right? You got 2x4 frame construction with either brick, veneer, or vinyl siding, some type of siding on it, or what have you. But if the fundamental construction of the company is something a little unusual, like maybe it's a complete stone house or it's a log house, that's going to impact not only the premium, but also whether the insurance company will even be willing to insure it themselves. Insurance companies like to insure things that they understand. A lot of the more esoteric construction methods, they don't really understand. They don't do enough of them, so they just make an easy decision to say, we're not going to insure those houses. All that means is if you're selling a house that's a log home or something like that, know up front that you're going to have a little more difficult time, or the person buying it's going to have a little more difficult time finding insurance, and it's likely going to be more expensive than an equivalent square footage house built with normal construction. Not a showstopper, but just something you need to know about. And then, of course, the other things that go into figuring the replacement cost are any additions you have. You know, are there decks or porches? Do you have an attached garage, etc., and all that square footage? The point is that the replacement cost that gets calculated has little bearing on actually what the market cost is, how much somebody paid for the house, or even what it's appraised at from a tax standpoint. The graphic below shows a $400,000 house where the actual replacement cost is calculated $250,000 because it's not including the cost of land and site improvements, etc. We see it actually inverse sometimes where the replacement cost is higher than the market value. Why? Because a lot of times if a developer is building 100 homes in a development, their cost to build a house is less than somebody going to replace it doing one at a time. They get economies of scale in the construction, they get economies of scale in materials, etc., like that. Where if it's a one-off rebuild of a house later, it may cost substantially more. So again, I have to explain to people the replacement cost has little bearing on what they paid for it, maybe less, maybe more, but you just have to understand what it is. So just focus that, getting good information so we can do an accurate replacement cost, make sure that we properly insure the house and don't over-insure it or under-insure it. All right, the other key thing, if there's one thing I want you to remember about this from a realtor perspective, is that the roof age is absolutely key. Insurers focus on the roof probably more than any other factor. Why? Because, windstorm damage or leaks from roof caused in the roofs are probably the #1 source of homeowner claims. Most insurers will not insure, period, a house, will not write a new policy on a house if the roof is over 20 years old. Nationwide, for example, will not write a new policy on a new house if the roof is over 15 years old, period. Doesn't matter if you've got, quote, 50-year or 35-year shingles on it. Doesn't matter. If it's over 15 years old, not writing policy. All this means is that for a house that's older than 15 or 20 years, if the roof has not been replaced, they're going to pay more for insurance because they're going to be limited in the choices. The number of companies who will insure them are going to be less. So finding out the roof age and being able to document that is actually critical to be able to get affordable insurance. And another thing to keep in mind is, like, kind of hard to believe now, but anything built in the 20th century has over 20 years. The roof is 20 years old. Anything built in the 1900s, which does, for me, I mean, it seems like just yesterday for me, but that's over 20 years old. So if the roof has been replaced, which most of them probably have, just finding out that age, and all they care about is the year, I just need that and be able to document it if anybody backs it up. Some companies care about if the roof's been replaced, how many times it's been replaced, how many layers of shingles you have on it and things like that. They focus on the roof. There's a lot of questions about the roof. So when I do a policy, I have to answer these questions. And so I've got to get the answer from somewhere. And you'd be surprised how many people, even when they own the house, can't tell you the last time the roof was replaced. But it's a real critical thing. And like I said, if you say it's 10 years old and the inspector goes out there and he thinks it's over 20, guess what? They can cancel the policy or make you replace it after the fact, which nobody wants to see happen because nobody can be happy at that point. So I would ask you, when you're listing a house, find out what the roof age is. If the person doesn't know, have them go research it. Somebody's going to be asking them sooner or later, so ask them now. Let's say. This one gets kind of interesting. So prior losses matter. If you have a house, any losses that it has had are going to impact the cost of insurance for it, even if, for a new buyer. So most companies, if you've had more than one, and certainly almost all of them, if you have more than 2 losses in the last 3 years, they will not write the house. Will not write a new policy on the house with in many cases, 1 loss in the last 3 years. All the numbers I'm giving you here vary by insurance company, but these are typical. And so the vast majority of the companies that we represent, which are names you've all heard of, if you've got more than 1 or in many cases 2 losses in the last 3 years, will not write the house, period. You got to go find something else. Doesn't mean we can't find insurance for it. There are these companies there are other companies that do, quote, higher risk things and things like that, but it does mean it's going to cost more. So you need to be aware of that. The other thing is that 0 payout claims count. What does that mean? So we have windstorms around here all the time, right? Roofing companies show up in neighborhoods. Hey, I want to look at your roof. I'll inspect it for you. You know, what's your insurance company? They'll pay for it if it needs to be repaired on. Don't give them the answer. Because what do? They go up on your roof and they come back and say, oh, your roof needs to be replaced. We'll do it. We called Nationwide. They'll take care of it or whatever. Guess what? As soon as they called them and told them that, guess what Nationwide did? They filed a claim against your roof. They said, you've got a claim. You look at the roof and you go, I'm not paying that. I'm not going to get that done. Guess what? You have a zero payout claim on your record. And that zero payout claim counts as one or two when somebody goes to reinsure that house. So now we can argue all day about whether that makes sense or it's logical or even right or whatever. That's just the way it is. And so be very careful about that. So home losses. So when somebody's buying a house, people say, well, why should I have, why should the losses that the previous owner have count against me? Well, again, insurance companies look at it different ways. Some companies only look at it in terms of their eligibility, meaning that, hey, I'll write a house with 2 losses in the last 3 years, but the previous losses of the previous owner count in that equation, whether I write it or not. Some of them will actually use losses in developing the premium. I mean, they'll jack the premium up with their previous losses. Some only use it for eligibility. Some use a combination. It varies. It's no standard. Again, it's legalized gambling. They're all using their own formulas and how they're developing their premiums. But the key thing is, like, from a real estate person, you're selling a house, selling somebody a house, they're going to need to know, or their insurance company is going to need to know about the previous losses. And so if the previous house has multiple losses, you need to know, so they know that their insurance is going to cost more because it's going to be harder to get, just the way it is. So what I say from a real estate perspective is you need a clue report run on every property you're listing, or any property that if you're representing a buyer that they're interested in. Find out what the losses are. How do you get one? Call an insurance agent and ask them to run one for you. That's what I would do. And I can do that. And so that way at least you'll know what the situation is. It doesn't make the problem go away, but at least you know about it, you can deal with it. The other thing, the next thing I'll talk about that affects the cost of insurance is location. In real estate, location is everything, right? Well, around here we've got a lot of fairly rural areas, and so every address in the United States has a fire protection code. It goes from fire protection class from 1 to 10. 10 being the worst. It's all based on the emergency services of the locality in terms of how close is the fire station, what's the response time, is it professionally managed, man versus volunteer, or a combination of thereof. Classes, and so the higher the class, the more the risk is, so therefore the premiums can be higher. If it's class 9 or 10, that's where you start limiting the choices. A lot of companies will not do 9s, even fewer will do 10s. And there's a fair amount of 10s around here, even in fairly developed counties like Stafford. I ran into one the other day. The guy was class 10, living down the Whitewater area. And we were having a heck of a time finding him insurance just because he's remote. That's the way it is. The other factors are the water. Not so much an issue specifically around the Fredericksburg area, but if you get down to Northern Neck or anywhere close to the bay or the ocean, then that becomes a factor. Although some companies care about any body of water, so somebody could be close to the Rappahannock or the Potomac, and it would start to affect them. And again, it affects the rate, or in some cases, and companies will flat out say, we will not write something within 1,500 feet of the shore or whatever. So just a factor that needs to know. Insurance is probably going to be a little more difficult to get, or a little more expensive because of the location. The other thing, again, this is fairly common around here, is that wind is a big cause of damage. Probably the number one cause of homeowner claims around here. We've all seen it with roof damage and so forth. We're not considered in a high risk wind zone here. Like Virginia Beach and places like that are, they're, because they're close to the ocean. But in some cases, if you're in a zip code with a high wind rating, they can force you to make the deductible on your dwelling 2 to 5% of the dwelling cost. What does that mean? Well, if I've got a $500,000 house and I've got a 2% deductible, then my deductible for wind and hail claims is $10,000. meaning I've got to have over $10,000 worth of damage to my house before I'm going to get anything from the insurance company. A lot of times you'll see people with very cheap insurance policy, they'll be real proud of it, and you look down and say, well, what's the deductibles? And you'll see 1 or 2% of the dwelling costs and realize that they've got extremely high deductibles. So sometimes that's a choice. You can choose to do that to lower your premium. Sometimes the insurance company will force you to have that kind of deductible because of where you live. So again, it's just location is a critical area. The only way to find out is, ask an insurance agent to look at it and see if it falls into that category for that particular location. But something just to be aware of. The other thing about houses is, everybody loves the 4 or 5 bedroom frame constructed colonial around here, insurance companies included. Why? Because there's so many of them and they understand them. But if you get into unusual type construction like log or a dome house or something like that, there's a lot fewer of them, and insurance companies don't understand them. So there's fewer of them who are willing to write them, and and the ones that will charge you a lot more money. So if you've got something unusual, just know that that's something to be considered. Other things, if you've got, particularly in older homes, galvanized plumbing, polybutylene plumbing, which I don't think there's much of that left around here anymore, or something Brooke mentioned to me the other day, underground tanks. A lot of rural areas have oil tanks and things like that. If those are still in the ground, it will affect the insurance premium, or in some cases they won't write the policy if that exists. So if that you need to find out if it exists. Again, it doesn't mean we can't find insurance for it. It just means it's going to be probably more expensive. You need to be aware of it up front. Acreage matters. A lot of places around here got the little 10, 15 acres or something with them, and people have a little farm or something. Again, a lot of insurance companies maybe will write up to 5 acres. If it's more than 5 acres they won't, or they're going to charge you extra for it. So again, it's going to limit the choices you have. It doesn't mean you can't get insurance. Doesn't mean you can't find reasonable insurance, but it's going to force you to go to certain companies versus others. Animals, you got a horse in the backyard, or maybe you got a couple of cows on your 10 acres or something like that. That again, that's a factor that's going to issue into their into your insurance rate. So again, it's just something to be aware of and to know about. So and again, the more you know about it ahead of time, the better off you are, because then we can deal with it. The standard homes are really easy to do. I can literally write a policy and issue it in probably 20 minutes. If it's got any of these other weird things, it may take days. I may have to go to underwriting approval. I may have to shop it to multiple weird carriers to find somebody. So it may take longer. So it's a key thing. We can always find somebody insurance. It just may be more expensive than they want, but we can find it for them. So the 3 takeaways I want you guys to remember is that when you're dealing with listings or you're out working with your buyers and they're looking at various properties, find out early in the sales process, what's the age of the roof and the HVAC systems? When was that replaced? And get documentation if you can, so you know it's actually accurate. So why? Because when it comes time and they write that contract and they're looking for insurance, it's one of the first things the insurance agent's going to ask that client, and they're not going to know, and they're going to turn around and ask you. So ask up front so you got the information. And then if there's something non-standard, it's a log home or some weird constructed home, or it's in a very rural location, something like that, just know that those are challenges, and kind of prepare your buyer and say, hey, it may take a little bit longer to get your insurance. We need to make sure to start looking at that earlier. And then know the loss history. Find that out. If you're listing a house, you should just ask your seller, hey, what's your insurance loss history? If they don't know or can't remember, just ask an insurance agent. Give me a call. I'll run a listing run a report for you so you know what it is. Because it's going to come up, and you don't want it to come up 3 days before closing, right? Let's deal with it up front. So the key takeaway I would have there is just start the insurance process early in the sales cycle. In a standard simple house, it doesn't take long. We can knock it out and get it out of the way easy. But if there's some challenges ahead of time, it may take me days or even a week or so to come up with a good option for insurance for that. And Chad's going to need it when he's trying to do the mortgage application. And so the sooner we can start that process, And the more accurate information we can get, the better outcome we're going to have. So that's kind of the three takeaways I'd like to see y'all to remember. Look for things non-standard. Get the age of the roof and the heating system in particular, and find out what the losses were. So anyway, so that's what we're at. Just leave it at this, and I'll turn it back over to Chad. Let him comment.
Appreciate it, Richard. Yeah, so for those of you that just joined, I'm Chad Hallett with Movement Mortgage. Apologize for the folks watching this, but I didn't start recording it until we're 5 minutes in. You just heard the main man, Mr. Richard Bibb from Goosehead Insurance, give us a breakdown on what goes into your homeowner insurance quote and your premium and what you're paying annually and why is your escrow what it is. I'm going to open it up for questions for him in just a second, but I just want to touch on one of your key takeaways, Richard, real quick. For you guys doing listing, you realtors, I apologize, that have joined us, that are doing listings, that could come into play. That could be a huge thing, what he mentioned about the previous losses. That's a good question to ask your client up front, because when I'm pre-qualifying somebody, I'm going off of their zip code, I'm going off of the type of the home, I'm going off of my experience on what it's going to cost them at their price point. So I put an average or a guesstimate in there, and I pre-qualify them based on that. And depending on the program, some are more stringent than others, as you guys know. Maybe they're a first-time home buyer trying to use VHGA. It could be razor thin to this point I'm trying to make. So if, like Richard said, there's like 3 previous losses in the last 2 years, and all of a sudden their insurance is going to be $150 a month instead of 45 like I quoted them. All of a sudden they just blew their 45% DTI, and we can no longer qualify them for that loan, and then your deal can fall through. And who wants to? I realize that right now it's a seller's market, and you guys would most likely be okay a couple weeks later, but who wants to waste that 2 to 3 weeks? And I know I sure don't like working for free. And with that being said, Richard, could you, before I turn it over to them, could you rehash a little bit without disclosing personal information about how you helped me out and how we were introduced? Because I just had a client that he mentioned the wind damage and just got into a home, and like I just said, luckily he had plenty of room in his debt to income ratio, but we were expecting $50 a month, and all of a sudden, wham! I think I was like,
yeah, I don't remember the exact numbers, but yes, Chad called me and said, I had this client, and his insurance came in really high, and he's dying because the house he purchased had numerous losses against it, and I think a couple of them were $0 losses, but there were a couple of legitimate wind damage losses. His house out in Orange County, and then on top of that, the purchaser owns a house in Indiana, and he had some losses against that house, and he'd owned a house in Stafford previously, and he had losses against that house. So he had previous losses on his side, and then the house he was buying. So luckily for him, I guess the insurance company had written a policy, but it was in the order of $3,000 a year or something. It was ridiculous. And this is a nice house he was moving into, but it wasn't a $3,000 a year house to insure. I mean, it wasn't a mansion or anything. And I was able to get all the facts and work with the insurance companies. And this is where it gets into. I mean, all of these things I've talked about, these are underlying guidelines. They're not hard and fast rules. I mean, and believe it or not, insurance underwriters are human, and they are people, and they have some logic sometimes. So I was able to kind of go back through and work with them on the specifics of the individual case and get some of them to toss out some of the $0 claims and whatever. And bottom line is, I was able to get him some insurance that was about $700 a year less than what he was paying, and actually increased the amount of coverage, and increased the liability coverage, and actually I think I increased the actual dwelling coverage a little bit, if I recall correctly. The bottom line is I was able to do that, but it still took me about a week or so going back and forth between the insurance company and the insured and getting a bunch of information, documentation, and everything else. It wasn't a slam dunk, but we were able to do it. And so the key takeaway I'd say there is, you're not going to, by avoiding dealing with the problem, you're not going to make the problem go away. So if there are loss problems, get it up front, work with somebody like me to go try to work through those issues early in the sales process, so it doesn't come up like Chad said, and all of a sudden, you know, maybe you had a case where it is a tighter DTI ratio, and the insurance blows it, and the whole deal falls through. And so, you know, we can deal with anything. You know, we may not be able to pull miracles, and you know, in some cases, the insurance just may be what it is, and may not be able to make a loan work or what have you. But at least you'll find out early, and not waste a lot of time on it. And the buyer will be prepared too, about what he's potentially dealing with that particular home, and he'll be going into the next transaction not more eyes open. And the seller of the house will deal like, okay, I've got a challenge with my house, and maybe there's something he can do to mitigate something. Maybe the roof age is an issue, and maybe he's got to replace it, or maybe that becomes a negotiating point in the sale, or what have you. But I mean, like, just get the issues out front and on the table, and the sooner you deal with them, the easier it's going to be.
Correct. And not to pat myself on the back, but just to give you guys a feeling on how I operate. I actually got together with Richard on this after the closing. So a lot of guys can say, oh, you know, I care about my clients, blah, blah, blah. But I knew my guy was not being taken care of by the other company, and I wanted the best by him. You know, fellow soldier, you know, veteran. I wanted to make sure he was taken care of. And even though me and Richard had never done deals together before, he talked a good game, and then he backed it up, and I really appreciate that. And now that's why he's at the top of my insurance referral list, because you know, he doesn't just talk; he proves himself. Right now, before I get into the mortgage side of this webinar, if you guys want to unmute yourselves and ask Richard any questions, you feel free.
I must have put them all to sleep.
That's right. I swear I only yawned once.
Well, I mean, it's like, I wanted to say up front, I mean, it's like talking about insurance right after lunch is probably not a good idea.
I know, we should have planned this before lunch, right?
It's not the most exciting topic in the world.
Hey, Richard, it's Brooke. And I know we talked just about a week ago about this. Can you touch on animals, dogs?
Yes.
We talked about this last week. I think it's important for people to know.
Yeah. So almost all insurance companies have, you know, part of their underwriting equation, or one of the questions that we're going to ask is, does the insured own a dog or dogs? And then they're going to specifically ask about breeds. And every insurance company out there has a list of breeds that they have concerns about, you know, and it's the Rottweilers, Pit Bulls, Akitas, etc. And however, the list varies. I mean, the breed list will vary by insurance company, so it's not all universal, but those are probably three of the most common ones that are concerned. And insurance companies will deal with those in different ways. Some cases they will flat out refuse to. They will insure the house, but they will exclude liability for the dog. So you have no liability coverage for the dog. So if the dog bites somebody, you're on your own. All right. Or some cases they just say flat ineligible. We won't write a house for that dog. I mean, that's, you know, and then in all cases they'll ask if the dog has a bite history. So even if you've got a Chihuahua, if it's got a bite history and it's bitten somebody, they're going to hit you with it. The point that so you just have to be aware of that. They don't care about cats. Don't know why. I have a killer cat, and it's probably more dangerous than any dog, but, you know, I get a pass because it's a cat. They do care about dogs, so they're going to ask about that. The premium increase for having one of those dogs is not that much. It doesn't cost that much more to have it, which is ironic, but, you know, that they do ask. Now, the question that Brooke asked me about the other day, which I did a little research on, was this, so what about a case where, say somebody has a service animal? In a particular case, she had a military service guy that had, you know, had PTSD, and he'd been prescribed a service animal, so he had a therapy dog, essentially, that was a German Shepherd. Well, German Shepherds are on the list of breeds, believe it or not, for some insurance companies. Not all of them, but in some they listed as a breed they're concerned about. And so I had done some research to see, is there any exclusion for service animals? There is none. Insurance companies don't have that is written into their guidelines anywhere that there's any kind of exclusion. Having said that, again, I did check, and some people that my company said they had seen experiences where that was brought to the attention of an underwriter, and they wrote a special exception. So they would allow service dogs. So again, if you know, it's all about information finding up front. You know, You have a dog. What kind of dog is it? Great. Okay, great. If it's on the bad list, let me know, and then, or ask me, find out if it's on the bad list. And, we can either find a company where it's not, or find out what the impact is. And if it's a service animal or something like that, this is something I'll need to know. I'm going to have to go to underwriting and ask them for an exception. This is going to take 24 to 48 hours typically to get an answer. So again, it goes back to deal with any particular issue up front. The sooner you get it, we can deal with anything if we give it enough time. It's just, don't call me the day before closing, say I got to close tomorrow and write this insurance policy, because it may not happen. Right.
All right, well, appreciate it. Anybody else before I move it down over to mortgages? All right, if not, I'll go into my deal. Richard, thanks again for spearheading this and having the thought to get together on this. I appreciate it. And my deal is going to be real short and sweet. You guys all work with different lenders, and you have a general idea of definitely know what kind of real estate market we're working in. I just want to touch on CARES Act, how are we handling forbearance, current interest rates, whether are they now, what are we seeing or predicting for the future, and also turnaround times and getting files closed. So we'll start off with COVID business forbearance. I just had a realtor reach out to me from Northern Virginia who said, hey, none of my lenders can give me a straight answer. What is the straight answer on people that are trying to sell their home and they're currently in forbearance and they want to purchase a new home? There's a few different ways to handle that. If they're in forbearance, a lot of times you just call and say, hey, forbearance, and they throw you in it, whether you want to do it or not. They just, after the phone call's over, they just type it in the system. I deal with that with a lot of clients, and they've never been in, and they never stop making their payments. So that's option A. If they've been making their payments all along, no problems. Next thing is if they are indeed selling their home, then as long as that transaction closes before our note is recorded, before our closing, then we're good to go. Because that's gone, it's erased. Because the true definition, the true standard is you need to resolve that prior to your next mortgage. So if you've resolved that by paying off that mortgage by the sale of your home, then we're in a good place, we're good to go. Sorry, I thought you had a question. As far as refinances go, I know that's not your guys' primary concern, but pretty sure we're still in the same standard that they need to make 3 consecutive payments. They need to be in a good place with their current mortgage servicer, which just simply means they've established a repayment plan. So the steps are you call, you say, hey, I've been affected by COVID. I need to take a tactical time out for my payments. What can you do for me? And they'll put you in it for 3, 6, 9 months, whatever. And then at the end of that, they'll come up with a repayment plan. Most companies will either offer you to catch up through extra payments in a 3-month or 6-month setting. Some will allow you to tack it on to the very end of the loan. And some will say, hey, let me see that cash right now, everything that you should have paid us, stat. So depending on their situation, if they've went ahead and taken care of it, then we're also good in that scenario. Moving on to rates. Rates are still phenomenal. We're still, for the well-qualified buyers, we're still in those mid-2s. And, it depends. And what's really surprised me from day one is how well conventional has gone. Traditionally, conventional is a little bit higher. I know you guys as listing agents appreciate it. They have a little more skin in the game. They have less standards on the appraisals and inspections, all that jazz. But very, very good rates right now for conventional. And they're right neck and neck with the Gubby loans. So FHA, VA, and all that good stuff. And then what was next here? Oh, what we're predicting for the future is initially back in July, we were thinking September, we're going to start seeing an uptick. And that hasn't happened. Now, the Fed, they have made a change for conventional, but it's only affecting refinances, which again isn't your primary concern, but they have a adverse market fee. That's like a 0.5 percentage point. So basically like a discount point that you'd pay to buy your rate down. Well, now there's automatically a 0.5 point tacked onto that. And that's the government, that's not movement. And then as far as the prediction for the future, we're looking at a very good fall where everything's pointing to rates are going to continue to stay in the 2 range and to the low 3s. So we're not seeing any issues with that. What was that last thing I was going to talk about, Richard? Turn times. Turn times, name of the game. So people are, again, calls left and right, like how fast can you get this closed? Movement's always been proud of its, 6-7-1 model. So 6 hours for average for underwriting, 7 days for processing, 1 day for closing, right? And I've definitely closed loans in as little as 2 weeks with movement, and it's definitely a tactical advantage when I'm getting my hands on Navy Fed's loans and some different companies. Too easy to steal their business when they're taking 2 months to get it done, right? Well, now we're seeing a little bit different. So I feel like we're still competitive. We're still better than the rest. Of course, I've, got a reason to say so, but we've just been pumping it out nonstop. And I just shared on social media a graphic telling our most current times, which are still phenomenal. We're still closing loans in 30 days or less, depending on the circumstances. Where do I want to go from there? Basically, long story short is I always tell my agents, I put in there what you think we can handle for the appraisal. Because when we get that appraisal, my team's already locked and loaded. We've got it done. I've got a stellar team I work with, and we have that loan accomplished prior to that appraisal being done. As soon as that appraisal report comes in, we get it back to underwriting, and we're ready to rock and roll. I'm not having any issues with any loan programs whatsoever. I heard, again, another lender told one of my agents that USDA isn't currently doing them because of COVID, and they don't have anybody working. That's fake news. They currently have a 7-day turnaround time once it goes to them, just FYI. All the loan programs are doing good. VHDA, we're a delegated lender for VHDA, so we're still knocking them out left and right, and no issues. So yeah, just speak to your loan officer, have that conversation. If you guys have a problem with turnaround times or you're concerned, hit me up. I have no issues discussing it with you. Our company has done very well with plussing up our staff. Everybody's trying to steal from everybody. One of the numbers I was supposed to lead it with that I forgot was the mortgage industry right now, as of like 2 weeks ago, has increased from last summer 497%. So can you imagine what that does to, like, it's not us being slow. Can you imagine our processors, our underwriters, our closers, everybody that works in the ops team and the chain? That's a big strain. We got people working nights, weekends, and we laugh and joke about it. It's legit. They're working around the clock, and we've invested heavily in our ops team. So we love and appreciate them so much that giving them basically a blank check for overtime and retention bonuses and buying back vacation time, whatever it takes. And they've been willing to do so. And that's why I love working with this team is, they're willing to do anything it takes to accomplish the mission. So did any of you ladies have any questions as far as the mortgage side of things or anything on that end? Brooke's shaking her head no. She says, I'm disappointed because your bald head's shining in my face the whole time.
I'll ask a question. So one of the problems that routinely occur in a growing market is appraisal problems. So what are some of the best remedies that you've seen if, for instance, it's a conventional mortgage and we need to file an appeal on the appraisal because the appraiser came from, it's just ridiculous. So what have you seen has been kind of the best practices with that, since you've probably seen a few appraisals come in low?
Yeah, earlier this year, when COVID first kicked off, the refinance business just boomed. And all my purchases were just fine, but the refinances, those appraisers were going nuts. They're going low, low, low. Now it's starting to hit the purchases. Why is it doing that? Just like Brooke touched on, we're so dang busy, and you guys want to get things closed fast. We want to get closed fast, so we're pulling appraisers from wherever we can. So now you're going to have a gal from Charlottesville coming up the Woodbridge to appraise a house. She's not an expert in that market. That's insane. But we're doing what we can do to accomplish the mission. So what we've had, this happened 3 weeks ago with me. It was in Northern Stafford. They came in 20 grand lower than what was expected. And what I explained to my realtor partner, Mr. Brian, was that we have a rebuttal system in place with movement. And of course, you guys know that I'm not allowed to talk directly to the appraiser. I can't have any undue influence. So we have a form we fill out, and we have a independent individual that reaches out to the appraiser and gives it to them, and then they have 24 hours to respond. So my big thing was that from previous experience, I had very little luck at getting those changed. What I did different this time is I said, Brian, listen, pal, why they make me fill this out, I don't know, because it's asking for comps, it's asking for different features of the home. I can see the pictures online, but I don't know. You know that home inside and out. You're the one that sold it to the client. Help me out here. So I forwarded him my information, what criteria we asked for, gave him a template basically to work off of. And then he went to work and doing salesmanship. He sold on why that home was worth more money. And the end result was we didn't get everything we asked for, but she met us halfway. We got an extra 10 grand back on the table. She ignored some of the recent upgrades. That house was basically gutted and redone, but she ignored the value, and some of her comps were off. He just did a phenomenal job, and he gave me the tools, and I just used them, passed it on. And we had a positive result in that circumstance. It's not a guarantee, but that's the main way forward. Now, if you do have a serious issue, you do your rebuttal, and I'm not talking about, as we say in the Army, a hurt feelings report, but if you have an issue and you think this appraiser is just out of her league or his league, and they're just not doing their job properly, and they're just out of left field, there is and don't ask me to tell it to you right now, but there is a method for you guys to report them. And then they will go through the chain and they'll do their own investigation and say, hey, this guy needs retraining, this guy needs to lose their license or whatever. But what I've seen over the years, and when I've interviewed appraisers and spoken to appraisers directly outside of transactions, the thing is that nobody reports these people. So if you don't report them, you just complain, kick the can. You're kicking the can down the road. And then Gabriella's got to deal with it on the next transaction. Miss Arlene's got to deal with it. So if you have a problem, tell them you have a problem. I don't have the contact information for reporting them, but possibly your broker does, or Mr. Google does. But, say something, and that'd be my advice going forward. Miss Gabby, Miss Arlene, you got anything for me? We good? Well, thank you very much, ladies, for joining us. Thank you very much, Richard, for spearheading this. Like I said, I basically did the flyers, but Richard came up with some good points. And I've always thought of homeowners insurance as a buyer's problem, not a listing agent's problem. So that was very awesome that you're able to share some tips. That I definitely learned something today. Gabby says thanks. Gabby, thanks for coming. We appreciate it. And we'll go ahead and end this now. Thanks, guys. It was good meeting you.
Thanks.